In this module, we are looking at pricing and valuation of futures contracts. Last module, we did forward contracts. We will see that the initial price of a futures contract, we calculate it in the same way, but valuation is different because of the mark-to-market. And the best way to show that is to simply show it with an example. So let's just start off with pricing out a futures or a forward contract. We'll follow the mark-to-market through, and we'll see the difference in valuation between a forward contract and a futures contract. Let's start with gold. We're going to take a contract that is for 100 ounces of gold. The spot price today is $17.70. We have a risk-free rate for all periods of 2%. And the contract term is 91 days, and we'll be pricing out we'll be taking a long position and mark-to-market a long position. If we calculate the forward price or the futures price, it is just simply the spot price multiplied by 1.02 for the term of the contract. That's to the power of 91 over 365. We'll get 1778.76 for both the forward and the futures. Notice the notation here. We have little f for futures, capital F for the forward price. The valuation or the value of the forward contract on day one is 0, as it is for the futures contract. The futures contract is going to require margin, so let's make the assumption that it's $49.50 in margin with a maintenance margin of $44.50. Okay, let's begin on day one. Let's assume that the futures price fell $5. Notice what I said here. The futures price fell $5. We're not worrying about the spot price right now. The futures price fell $5 because a futures contract is marked to market by the change of the futures price, not the change of the spot price. So it is the change in the futures price that is marked to market, not the value of the contract from day to day, the value being the difference between the spot price and the discounted forward price. That's for forwards. Okay, so we'll put F1, meaning this is the futures price on day one is $17.73. Our futures price on day 0 was $17.78. We have a $5 loss, so the long position will have a $500 mark-to-market loss. $5 on the futures price. Each contract is for 100 ounces of gold, so you multiply it by 500. The value, once we handle the mark-to-market loss, once we settle up, we do our daily settlement, the value on day T, whatever day it is reset to 0 every single day. So once we settle up our mark-to-markets, the value of the contract goes to 0. Well, that's not true for the forward contract. The forward contract is not mark-to-market, so it has a carrying value from day to day. Futures contract doesn't. If the futures price fell $5, what was the change in the spot price? Our futures price is $17.73.76, so we'll just discount it at 2%. Notice one day has passed, so we're not using 91, we're just going to use 90. That would correspond to a spot price of $17.65.12. So the value of the forward contract on day one is the spot price minus the present value of the forward price. It always stays as a constant forward price. Discount at 1.02 for 90 out of 365 days, and we have a loss of $4.98 per ounce of gold, but the contract is for 100 ounces of gold. Notice the difference here. The forward contract is down $498. But the futures contract has a $500 mark-to-market loss because the futures contract is mark-to-market based on the change in the futures price. The value from day to day of the forward contract is the cumulative difference in whatever the spot price is, subtracting the present value of the forward price. Let's go to day 2. And you'll see that it carries over here. Let's drop the price of the futures contract by another $4. Again, note that I'm not dropping the spot price here. I'm dropping the futures price by $4. So the futures price is now $17.69.76. The long position has another $400 mark-to-market loss. As soon as it settles up its mark-to-market loss, the value of the futures contract goes back to 0. because we're settling up every single day. So at any point in time, I don't owe you anything and you don't owe me anything. We've settled up, the value must be zero. But the forward doesn't settle up day to day. If we have a forward futures price of 1769.76, that implies a spot price of 1761.24. We get that by taking the 1769.76. That is the futures price now. And we're going to discount it to get to the spot price. Notice we're using 89 over 365 now because 2 days have gone. This was a 91-day contract. So the spot price would be 1761.24. How do we calculate the value of the forward contract? It is the spot price minus the present value of the forward price. Look at this. It never changes. The present value of the forward price never changes. It's always fixed. So 1761 minus the present value of that, again, notice 89, we get negative 895. And since it's for $100, we're down $895. Look at the difference here. We have a $500 mark-to-market loss here. We have a $400 mark-to-market loss there. We're down $900 on the futures contract because we're marking to market the futures price. But here, we are determining the value of the forward contract by consistently taking the present value of the forward price and subtracting that from whatever the spot price happens to be. And of course, we're discounting it by 1 day less each time, 895 versus 900. Okay, let's sum up what we saw on the previous screen. For a forward contract, the forward price remains fixed throughout the contract period. The value of the forward contract at any point in time is arrived at by taking the spot price, whatever it is that day, minus the present value of that fixed forward price, and all gains and losses will be settled at maturity. For a futures contract, the futures price changes every day. Note the difference. This remains fixed. This changes every day such that the value of the contract equals zero at the end of each day. For this to equal zero at the end of each day, this has to change. When this remains fixed, the value of the contract changes every single day. See the difference there? And the big reason here, it's settled every day versus settled at maturity. At expiration, the gain or loss on the contract at expiration will be identical whether we have a forward or whether we have a futures contract. It is the cash flows during the life of the contract that differ. And depending on where interest rates go and the correlation of interest rates to the futures price or the forward price, there will be a slight difference in the value to the investor of having a futures contract or having a forward contract. You got that to look forward to. Right now, let's go on to interest rate futures. In the last video, or last module, we were introduced to the FRA, which is a forward rate agreement. It's a forward agreement on an interest rate. The futures version of an FRA is an interest rate futures contract. Notice we have little f over here to denote futures contract. And this is for some forward rate A, B minus A. So if we are at this point in time, there is A, there is B. It is for when. It starts when? It starts at period A. And for how long? The period B minus A. That's all that is. We can express it two different ways. 100 minus, and in brackets, 100 times the MRR if we're expressing the market reference rate as a decimal. But if we're just expressing it as a percent, which I find the easiest thing to do, it's 100 minus whatever the interest rate is expressed as a percent. Whatever we arrive at is called the futures price. It's referred to as an index or a price basis. So in other words, the futures price is quoted on an index basis. The index has a value of 100 when the interest rate is 0. And we have the same process as the FRA with the interest rate futures contract. Advance set, advance settle. So if we enter into an interest rate futures contract here, we will know what the fixed rate is on the contract there. And the futures contract settles at this point in time. The interest accrues over this point in time. But since we'll know what the payoff at time B is, it is just advanced settle. Advanced set, advanced settled. With a little bit of a difference. When it's advanced settled, we don't discount it, so that we end up with a linear relationship as opposed to a convex relationship. Just a bit of a look ahead here. So let's just understand the interest rate futures contract a little bit more. If you take a long position in this, you will earn the fixed rate. So let's see if we can allow you to see that in your head. Let's say the index is at a level of 98.25, and if we're going to use this formulation over here, that would mean that the interest rate is 1.75. So it's 100 minus the interest rate expressed as a percent. If the index is at 98.25, the interest rate must be 1.75. We're going to take a long position. So let's say at expiration, the interest rate is now only 1%. That means the index is at 99. So we took a position at 98.25. We went long. It went to 99. It's like any stock. We bought it at this price. It's at that price. We made money. So it's going to pay out 0.75 times the notional amount because we had a fixed rate of 1.75. It's gone up to 99, so the interest rate has dropped 0.75. We're long the index. When you're long the index, you are short the interest rate. It pays out 0.75. So when we go to make our deposit during this period of time, we'll make a deposit that only pays 1%. However, the contract paid 0.75, so we actually get 1.75%. We earn the fixed rate. Let's look at the short side now. So let's take a short position on that interest rate futures contract. The price was 98.25. When we have a short position, we end up paying the fixed rate of 1.75%. So we'll look at the index at expiration under two conditions, at 2% and at 1%. If the index is at 2%, remember it's 100 minus the MRR, so it's 100 minus 2 is 98. We were short at 98.25, went to 98, we win. Index ends at 98, the contract pays 0.25% times the notional amount. However, we have to borrow at 2% in the market now, but it is offset by that 0.25% gain. It costs us 1.75. Let's go the other way, 1%. That means the index would end at 99. We have a loss of 0.75% times the notional amount. 98.25 up to 99, we were short, there's your 0.75. We can borrow at 1%, but we have a 0.75% loss. In total, it's going to cost us 1.75%. We pay that fixed rate once we enter into the futures contract. If we're long, we're going to get that rate. If we're short, we're going to pay that rate because the contract offsets what would happen in the marketplace after. Let's revisit the idea of forwards and futures prices having differing cash flows and potentially having different values because of those cash flows. When we calculate a forward price or a futures price, both of them are calculated the same way. It is a function of the spot price and the present value of all income, the present value of all costs, and of course it is carried at whatever interest rate there is for the term. So just on those input bases alone, they'll have the same price. However, the cash flows differ. And there are two conditions under which those cash flows would not matter and the forward and futures would have the same price, because an investor would say, under those two conditions, I'm indifferent between the forward and the futures price. The first condition is interest rates are constant. Remember, for the futures price, cash flows are based on changes in the futures price. And we know that the futures price on any given day is whatever the spot price is carried to the end of the term. Every day, this term gets 1 day less. Whereas for the forward price, the value on any day is based on changes in the spot rate because the forward price is fixed once and for all. So that the value is the spot price minus the present value of some fixed price. So let's see what happens if interest rates are constant. Let's assume it's a 3-day forward contract and every day is a gain. Every day is a gain. For the mark-to-market, we would get money, we would get money, we would get money. Well, we can invest that money at R. So we can earn an interest on what we're investing. For the forward contract, keep in mind that when we discount back a fixed rate, we're discounting it back at 1 day less each time. So we inherently, the present value of the forward price will inherently rise every day by the interest rate. Because if you think about it this way, let's take $1 and discount it for 365 days. If you discount it for 364 days, it must be higher by 1 day of the interest rate. Exactly the same thing. If the interest rate is constant, the amount of money we can earn based on the mark-to-market is the same as how the present value of the forward price would climb every single day as we head to maturity, because they're both using the exact same interest rate. So let's put that mathematical concept into a sentence here. If, and this is the important part, right? If, it's a small word, but it's the biggest word in the English language. If the interest rate is constant over the life of the contract, since both have the same payoff. Both will have the future spot price minus the forward price, or the futures price as the payoff. The interest rate effects will cancel out. They'll cancel out if R is constant over the life of the contract. As we've seen on the previous screen, it is just simply a function of compounding and discounting at the same interest rate over the life of the contract. That interest rate won't change. Another condition under which the forward and the futures price would be identical, and that an investor would be indifferent between the two contracts, is if futures prices and interest rates are uncorrelated. And to make this argument, let's demonstrate what would happen if they are correlated. We'll start with the argument that the futures price and the interest rate are positively correlated. What does this mean? It means that as the futures price is going up, the interest rate is going up. And as the futures price is going down, the interest rate is going down. What will that result in? Any gains, any mark-to-market gains from the futures contract will be invested at higher interest rates. Losses, as we start losing and we have mark-to-market losses, they are financed at lower and lower interest rates. Well, forwards don't have that. Forwards do not invest their mark-to-market gains at higher interest rates. They forego this, but they do save the interest rate. But look what's happening. They are foregoing the higher interest rate, but saving the lower interest rate. So clearly, the futures are more important. Now, when we say that they're positively correlated, what if they were negatively correlated? What if, as you have futures prices going up, you have interest rates going down? Here, gains are invested at lower and lower prices. And if you have prices going down and interest rates going up, here your losses have to be financed at higher and higher prices. You would rather have the forward contract. So, if they're positively correlated, there is a benefit to being in the futures contract. If they're negatively correlated, there is a benefit to being in the forward contract. We would be indifferent between the two if you took away all the correlations and made them uncorrelated, which is what number 2 is saying. We would have the same price, forwards and futures, if interest rates are uncorrelated, because the investor would say, I'm indifferent. They're uncorrelated. It really doesn't matter. Let's move on to interest rate forwards and futures in terms of their differences in pricing and valuation as well. Recall, to hedge against a rising interest rate or reference rate, we would either short a futures contract or go long the FRA. If the interest rate is dropping, we are going to be, we would rather be long the futures contract and short the FRA. So before we go into looking at the difference in valuation, I want to make sure that in your head you see the relationship between short futures and long FRA, that they're actually doing the same thing. And we're still just on the pricing here of interest rate futures. So our pricing on interest rate futures, remember, is 100 minus whatever the interest rate is. On the FRA, we just state whatever the fixed rate happens to be. These two will be the same rate, whether it be the futures contract or the forward. The futures contract is quoted as a price basis on a 100-point index, whereas the FRA, we just quote the fixed rate. Let's make sure we clearly see in our head why shorting interest rate futures is the same as being long an FRA. Let's say you need to borrow $50 million in 6 months for 3 months, and you're going to pay whatever the interest rate is at that time. If the interest rate goes up during that period of time, because you're going to borrow it in 6 months for 3 months, if over those 6 months the interest rate goes up, your borrowing costs are going to go up. So you can hedge that now by shorting interest rate futures. If the interest rate goes up, the futures price goes down because it's quoted as on a price basis, you will have gains. You will pay the higher MRR borrowing cost, but it is offset by gains on the futures. So we can see that shorting interest rate futures is a hedge against rising interest rates. Let's go long the we'll go long the FRA here, and that is a pay fixed, receive floating. If interest rates go up, your borrowing costs go up, but you have gains on the FRA because you're going to be receiving the higher rate. You're going to pay the fixed rate, receive the higher rate. The difference between these two is the same as the difference between where you shorted the index and where it ended up. Great. There's the difference in pricing. We can see that being short futures is the same as being long the FRA, and being long futures must be the same as being short the FRA. Let's deal with the difference in valuation of these two contracts, the forward and the future. And the forward contract has a convexity bias that the futures contract doesn't have. And to see this, we're going to use basis point value. In other words, we're going to change the interest rate by 1 basis point, and we're going to see what happens to the value of the futures contract and what happens to the value of the forward contract. So remember, the futures are marked to market. So let's calculate a basis point. Let's say interest rates change by 1 basis point. How would we mark to market that contract? It is the notional amount multiplied by 1 basis point. Times period over 360, whatever the term is. So let's say that we have $1 million and the period of time is 3 months. What's the basis point value? $25. So if interest rates go up 1 basis point or they go down 1 basis point, the mark to market on the contract will be $25. $25 each time, so you end up with a linear relationship between the price and the yield. All right, let's look what happens to the FRA for a 1 basis point change. Interest rate at 2.21%. Let's increase it 1 basis point to 2.22%. So the net payment would be the difference in the interest rates multiplied by the 1 million. There's 1 basis point times 1 million times the number of days. You will find that this equals the $25 we had on the previous screen. But remember, for FRAs, this is the expiration. The payoff is over here. It's advanced settle. You have to discount it backwards. You get to 24.86, not 25. There is a difference. We mark to market the futures price, but for a forward, it is just the present value. It is whatever the current rate is minus the present value of whatever the payoff is. So we end up with this sort of relationship here between price and yield. As the yield changes, we have a linear relationship on interest rate futures. However, we have convexity in the interest rate futures, and we saw this in fixed income, that bonds have this type of convexity, that as rates drop and rates increase, you do not have a linear relationship between the two. $25 versus $24.86. We increased the price by 1 basis point, $25. Increased the price of 1 basis point, it was $24.86. And finally, we end with a discussion of central clearing, looking at futures and forwards here. Not much to take away. There's not a lot of discussion here, but 2 big points are made. For futures contracts, because of central clearing, a lack of liquidity to meet the mark-to-market would result in a forced liquidation. A forced liquidation is where your broker says you have until this time of the day to meet the margin call. If you can't, they liquidate your futures contract for you. They simply close it out. And since you had nothing to do with closing it out, it is called a forced liquidation. For forwards, if you have no margin or mark to market on the forward contract, the contract will survive to expiration, which means even if you had a lack of liquidity during the holding period, but your liquidity problems would clear up by the end of the contract period, you're good. You're good. For futures contracts, you have to have daily liquidity. For a forward contract that lacks last 6 months, if there's no mark to market, no margin required, you could have a period of 2 or 3 months in there where you can say, I don't need to worry about liquidity here. I won't need liquidity for another 3 or 4 months. You'll be good. If, however, the forwards have a central clearinghouse, or if the forward contract is such that it has to be cleared through a central clearing and margin is required, you have a situation where the cash flow impacts between the futures and the forwards become closer to each other. So earlier we demonstrated the desirability of being in a futures contract if futures prices and interest rates were positively correlated because of the mark-to-market. Well, if the forwards have to do the same thing, then none of that matters. There is no benefit to the forward or no benefit to the futures. The big benefit to the forward contract is this: if no margin or mark-to-market is required, you can do away with all of that daily liquidity. Well, that daily liquidity can sometimes be a drag in the portfolio where you have to keep a certain amount of cash to meet the mark-to-market. You certainly have to keep near cash to meet the margin, whereas a forward contract, you wouldn't have to keep that kind of near cash to meet the margin. Now, when we think about margin, you think, well, $4,500 is nothing. You have to think at the institutional level, not the retail level. The retail level may use one contract, $4,500. Okay, $4,500 for 30 days. How much interest could that have possibly been? At the institutional level, keep adding zeros. That can end up being a significant yield drag on the portfolio. That wraps this up.